welcome back to Building Wealth on the Go, a podcast by KLT Wealth Management. I'm your host, Brad Wilson, joined by my colleagues Courtney Beach and Joe Filiomeni. Today is June 19th, 2023, and we are back with Season 4, Episode 6 of our podcast. Last one before we take a little summer break on the podcast, and we'll be back in September. But important to do this one because there's lots to talk about. Last time we chatted was all about debt ceiling, heading into that sort of June 1st deadline. So ramifications from that, maybe we can do a quick little sort of summary because that's all long gone. That's old news now. It's only been about a month, but that's old news. So what was sort of the resolution of that, of the debt ceiling there? Where do we end up there?
Well, they raised it, so
surprise,
they made it really, really simple, right?
Surprise.
So basically, and this is one of the advantages of the U.S. obviously is that the fact that they can just keep printing more money, and that's essentially what they are doing. Is they're going to issue more debt in order to raise the dollars that they need in order to meet their budget requirements and stuff. So I think at some point in time they need to eliminate this whole idea on the debt ceiling, and I think it's, as we talked about at the last podcast, it's more of a political, give and take sort of a situation and stuff. So
it just seems like a lot of unnecessary drama, to be perfectly honest.
It was a political tool. Depending on who you ask, they either love the deals that were made or they don't love the deals that were made. So depending on where you lie, it's there's pros and cons to each. But at the end of the day, there has to be concessions, with that debt ceiling agreement. So it's done. It's moved on. Markets seem to have kind of reacted positively to that. Maybe some were expecting some bad news, but so that was the big sort of headline initially. And very shortly after, we ran right into interest rate decisions, right, a couple weeks ago. So interest rate decisions were really big. You'd seen inflation sort of raising or inflation sort of standing pat, and we needing to control that. A lot of fear around that sticky inflation. We've talked about it for a while. So the result of everything was rate increases in both Canada and Europe with a hold in the U.S. And seems like they're pushing the mantra that, we're going to be high rates for longer, like into next year. Don't expect any rate cuts this year. What is sort of the fallout of that going to be? Where are we headed when it comes to rates environments and what the impact is?
Well, it's really interesting because at the beginning of the year, I don't know if you remember, we were talking about, they're going to raise the interest rate, but then by the end of the year, they're going to start lowering and everything. But we've got what's called sticky inflation. So sticky inflation, you've probably heard this term, basically is when the prices are not adjusting fast enough to the supply and demand. The demand is changing, but the prices aren't changing with it. So that's the problem we're running into now. So, and every bank across the world is trying to change the spending habits of people and of companies, but it's just not happening. And part of the problem is that we're lack of globalization. A lot of people are bringing industries into their home countries. That costs money, not only just to move logistically, but all your workers are going to want to be paid more. The reason for globalization is to make things cheaper. And so now they have to be more expensive to, accommodate this new environment. So I don't think it's going to change very fast, but they're trying really hard, I have to say.
Yeah. And I think we should sort of note that the proper terminology was a skip and not a hold, right? And so then that's really important, and that's what you kind of look for in the Fed meetings is the wording, and they did say a skip and not a hold this time. So that's telling us that rates are going to have to go up further. But the question is, and we talked about this in the past, is that when you put the rates up, it's not a quick effect into the markets, into the economy. Let's face it, like the summertime is here, people are traveling, these trips that they've planned, they've already paid for and booked and whatnot, and so it will take some time to kind of funnel through that people come to the realization that maybe I shouldn't spend and do that extra trip or something.
Well, they say it takes about a year or two for a rate hike to actually translate to any actual change. So there's that. And I kind of disagree with you in the sense that I don't so sure whether or not they're going to raise the rate. They definitely can, but I get more of a sense that they're putting the language out there to stop people from spending.
Which ironically, they're spending more.
Yeah.
Because you see the markets, people are investing more money. The markets are going up, and then also, wages are super strong still. Like we keep we keep harping on the fact that wages are strong, but that's a big factor of sticky inflation, is that wages are really, really strong. The reason people continue to spend money, I think you are seeing people in a bit of more strenuous situations, but again, one of the big outcomes of interest rate hikes is mortgage renewal prices.
Yes.
And we're not seeing the rollover yet of people, and we're just starting to see it. And when you actually think of when rates were at their peaks, it was only about 4 months ago when we kind of got into that over 4% of the overnight lending rate by the central banks. So when we're looking at a year to 2 years out, that's next February before we're even close to that, right? So because that's when the Bank of Canada kind of hit their skip, as you might want to say, right?
Well, it's funny that you mentioned the housing, because I was just listening to something this morning where a household of $120,000 worth of income cannot, on average, afford a house in Canada.
Yeah.
Given the current rates, which is scary because most people aren't having a household of $120,000, and that's not including big cities like Vancouver or Toronto, which it has to be higher.
It's way over $200,000 for household incomes. Generally, it's around $250,000 if you're living in a major city. So, it is something to watch, and I think that's where unfortunately, the way the economy works, you need some bad news, you need some difficult situations to come on, and that's the word recession, right?
Yeah.
So we need that to level out the economy to get there, and it's just a matter of how we get there, and avoiding as much pain as possible while still wrestling it down to the proper levels is important.
Well, the other thing is, even though we've got on the portfolio management side and on the investment side, we do have some portfolio managers who have been predicting for a while that we're going to have a recession, and they're being very conservative. But I'm starting to hear murmurs from other portfolio managers. Are we in a bear market? Is it coming? And they're not talking about a recession anymore. But that's just a few, just a couple, like one or two out of the whole batch. But I'm just shocked that I'm even hearing the murmurs of it now. But that's where we're at.
Bull market.
Yeah. Well, and I attended last week a conference to that effect, and three of the portfolio managers basically are saying exactly like that. This is the beginning of a bull market.
Yeah.
And we're seeing a little bit of that because, in earlier progressions in the market, it's been very narrow.
Yeah.
But now it is starting to spread out a little bit and stuff. So is it possibly the beginning of a bull market? And these portfolio managers seem to think about it. Now, that being said, they're growth-orientated portfolio managers.
Yes.
So then they're pushing to that's what they want, that's what they need to see and stuff. So
but I think it's important to note, like on that point, I was looking at some stats. So we've talked about, the big 5, the top 7, the big 10. So to put in perspective, like the S&P 500 is one of the most widely sort of benchmarked indexes out there, which is the top 500 companies in the US, largest by market cap. And if you just take the index, the weighted index, the top 10 companies make up over 30% of that index, the weighting.
Yeah.
And if you look at the S&P 500 year to date, it's on a big roll, it's doing great. If you looked at the equal weighted S&P, so that means you take all 500 companies and you give them the exact same weighting, at the end of May, it was negative year to date.
Yeah.
It was down 1.5%. Now, like you said, Joe, it's opened up in June, up about 4 or 5% in June. So the market breadth has kind of spread out, and we've seen that sort of recovery. But what's been almost a false sense of driving and of market growth has been these 10 companies.
Yeah.
Right? Your Googles, your Teslas, your Amazons, your Microsofts, all those companies driving everything to the forefront. So it has been skewed that way. And when you look at the last, we can call it low in the market, which would have been October of last year, we are technically, up 20% from that, right? Or was pushing on the edge of that earlier at the end of last week. So, it is interesting to watch, but again, there's so many pressures that are still there that seem like extreme headwinds if this is really entering a bull market.
And another interesting thing is usually when we have another market cycle is usually the top companies are different, but they're not this time.
Yeah.
So it's, will they stay there? Will they not? I don't know.
Well, and the excitement, I think, which is really driving those companies, the idea of AI, artificial intelligence and stuff. And then what I thought was really interesting is that we've had AI for the longest time already. Like, our little home Google thing at home. Hey Google, or Hey Siri.
Careful, you might set off my alarm. Well, this is it.
That's artificial intelligence because it's listening to you and it's trying to figure out what you're saying and responding. And so then there's lots of news about AI and the different sort of ramifications of AI to the point where there's some people starting to say maybe we're heading down this path a little too quickly with AI. Like maybe this is not where we want to be. Is this going to be the Terminator world here and stuff where AI takes over? So.
Yeah, I think we're going to see some resistance with that sector just because you're hearing talk in the political sphere of creating rules and regulations on not going too far down Terminator lane, right? So I don't know about, and a lot of the AI companies too are small. We're talking about the big guys involved, but a lot of the ones who are actually, really delving deep into AI are small companies. And, just like any other startup sector, some are going to flourish and others are going to get bought out. They're going to go bankrupt. So, it's a bit of a wild west right now in that sector.
And that's important to note is, Google's not an AI company. These big companies, they aren't AI companies. They'll have a division that's focused on AI. But the true AI sector, like you said, Courtney, is evolving. It's new. It's a startups. And a lot of them are negative growth. They're not doing very well, because they're still trying to figure out the industry, how to make money, and where to kind of set their footing. And a lot of people look to those big 10, like you said, Courtney, they haven't changed. Everyone's comfortable with them. You don't really want to stray away from that. So that's sort of, where the AI space is at. And it's going to rapidly, I think we're about to see sort of the ramp up of it. And it might get to a point where it gets a little too far, right? With AI integration, and there might be some scale back and regulations on it and whatnot. But it's definitely an area I think that we're going to be talking about for the next years to come.
Yeah.
And it's going to be very, very popular as we kind of move forward. So that kind of moves us into a little bit of market outlook. We've touched on it with sort of what's happened recently with the Fed meetings and the rate hikes. They are expecting, the federal government's, a lot of analysts are predicting 2 more rate hikes of 25 basis points this year. So another 0.5 percentage point in total going up, or 0.5% in total going up the interest rate. So we may see that play out towards the end of this year. Again, it's all a guessing game.
It's a prediction.
It's a prediction. And what have we learned from listening to the central banks is don't necessarily take everything. Take it with a grain of salt because things can change on a dime because economic conditions can change on a dime. But when we look at it, we've talked about it. The markets have been rallying. It's been strong. There's a push, like you said. Lots of the bulls are out. The bulls are out.
Well, the confidence level is there, right? And I think, and I don't know whether it's just we're sort of desperate for good news, that we're just pushing things forward and ignoring some of the signs of recession, but maybe that's what's, we're just so desperate to move forward that we're ignoring and we're just driving prices up.
Yeah.
So that's got to come back at some point in time. That's got to come back, and we've got to get some sort of normalization in that markets, and I think at some point we will get into that recessionary period, whether that happens this year, next year, whether it's a soft or hard landing, nobody really knows. Obviously, the government wants sort of a soft landing as much as possible, but those are hard things to control.
And there's a few things to look at too, is where's the cash coming from? And as we ramp up this equity run here, when is the transition to bonds, to cash, to GICs for clients that are looking to be a bit more defensive, for people managing money who are in need of income streams, bonds are going to be looking a lot more attractive when we sort of end this rate hike cycle, right? So, there's going to be rebalancing and retooling positions, and that could cause a stir in the markets if there's lots of money pulling out of equities because when people need money, they're repositioning, and that could kind of start a downward momentum as well. So there are sort of triggers that may occur with increased pressure on the economy as we kind of flow through the summer months and into the fall. And traditionally, the fall isn't the greatest for markets as well, right? So
you don't need much, right?
No.
Really, some negative news, some bad news that's coming, that we don't even know what's out there at this point in time, and that would, all of a sudden the confidence level in the markets would go down, and then you start seeing people moving to cash, ultimately, and once things start rolling, they roll, right, and stuff. So it'd be interesting to see how the summer sort of pans out.
Some recent pressures in Canada, we've seen some layoffs sort of expand. One of the big ones just in the last few days here was Bell Media laid off about 1,200 employees, and they shut down 6 radio stations across Canada. So very interesting kind of, some radio stations just shut off mid sort of day. And cut right off. So there's another, company out there, strong media company in Canada, it's laid off some employees, right? So maybe that's the first of more in the sector. Maybe that's the first of more companies to sort of head in that direction. But there's obviously a reason behind it, right? And they did mention they're not replacing all of those jobs as well. So will be interesting to see on that front from a layoff standpoint.
Yeah, maybe it's a sign of things to come. Like I think, often in the business cycle itself, right? If we're anticipating some tough times coming forward, now's the time to kind of readjust your business, and you begin to look at sort of areas that are not making as much money, and future growth is limited, so then you're going to start pulling some stuff back, and then the cycle then switches that once we're into recession, then you start spending money during the recessionary period because you want to drive up, as you're heading out of recession, you want as much profit as possible. So from a business point of view, we could see more and more companies that are at a high right now begin to kind of relook and forecast out 2, 3, 5 years out, and saying, maybe it is time to adjust a little bit and have these layoffs or terminations.
Yeah, and I've been hearing more about companies just trimming instead of the mass layoffs that usually get in recessions. So maybe, that's what we're going to be seeing this time around. People trimming, because people did lose employees during COVID. People retired, they didn't rehire. People, wanted to work from home, or they needed to be at home because their kids were at home, so they, just stopped working for a period of time. So I think we're going to see more companies just trimming, at least to begin with.
Yeah.
And it will be interesting to see because, if they are trimming, that could be a little bit of more of a leg effect into the economy.
Exactly.
Right?
Exactly.
So it could be that sort of delay that we are seeing in that. And to your point, Joe, too, with sort of business owners and those big companies, they understand the economic and market cycles. And I think a lot of them know that what comes with a recession is quantitative easing, right? And so there's going to be more favorable conditions for them to borrow money down the road versus right now. So why spend the money now when they can spend it later?
Exactly.
There's lots of factors in that will drive companies to change their positioning right now.
And the other thing is a lot of these companies got money when COVID happened. They got all this money from the government and they sat on it. They didn't spend it.
Yeah.
So they have longer to wait to do their trimming or to make layoffs.
Yeah.
And the other thing is part of the reason why we're seeing the big companies like Google and Amazon do well right now is they made their layoffs like a year ago.
Yeah.
So they're already starting on the other side of the cycle. So that's why part of the reason why they're ahead.
Yeah. And just the last point today we want to touch on is Canadian debt, just with the way our interest rates are, the way our housing market is. It is rising. It is the worst. Canada's the highest household debt amongst all G7 countries, and insolvencies are rising. right?
Yeah.
And so that's a pressure, we talk about it. We don't see it really reflective in the news. We don't see it really reflective in the markets, but it's there and it's growing, and it's a thing that we need to be, concerned about.
I think it's a cultural thing though too. Canadians are used to having debt.
Mm-hmm.
We're used to having mortgages. We're used to whipping out our credit cards. So it's partly a cultural thing, but now it's getting to a point where it might break some people.
Yeah. So
my concern with that is the spillover into the mental health situation, right?
Yeah.
It says finances to begin with are not a very easy sort of topic, and now that's coupled with heavy debt loads and potential for layoffs and stuff, and we may see a resurgence of the mental health situation kind of grow worse here.
Yeah, and I think a lot of people have been hanging on because they've been listening to the news that, like we've been telling people, the rate's going to go down or they're going to pause for a while, the Bank of Canada, and they just keep trickling up. So I think a lot of people have been just holding on for the next month's payments, and it's getting tight for some people.
Mm-hmm.
So it will be interesting to watch, because the biggest trigger factor with household debt and everything is housing, and so
Yes.
what happens in the real estate market in the next few months will be interesting to see as these rates sort of tick higher. And whatnot. But that wraps up our podcast today. We'll be back in September to kind of wrap up the summer, discuss all that goes on in the next few months.
Summer's usually quiet.
Generally,
We'll see
don't
what
jinx it,
happens this
Courtney.
summer.
Yeah, just don't jinx it like that, right? So, but hope everyone listening has a wonderful summer, and we'll be back and see you in September.